What is up, everybody? This is Scott Melker. We are live. Going to give a little time for people to start to roll in. Of course, the first comment here says, "But what about XRP?" Which is kind of like an inside joke here at this point because I tweeted recently that no matter what I do, no matter what I tweet about, somebody comes in and says, "But what about XRP?" I could be tweeting about like what my kids did for ate for dinner, and someone's like, "Yeah, but update the XRP chart." Funny. I get that a lot with Hex too. So I'm just giving everyone a little time.
Block too.
Yeah, just giving people time to roll in here on this Friday before the holiday. Awesome that people are showing up. So the point of this today is to talk DeFi. So you guys, just pulling some things up here. I've got Lucas Outumuro here from IntoTheBlock. They have been an amazing partner for me on my newsletter. Every single Wednesday, they provide like custom analysis, on-chain analysis. And it's something that I was never so well versed in and has been so helpful for me with my trading and analysis. So I'm so lucky they've done that. And so I asked Lucas to come here, and we're going to make this more of a regular thing to talk about various topics. Obviously, it's sort of switched to Bitcoin, I think, in the last few weeks that people are so interested in, but DeFi has been the thing of this year, right? It's been like nonstop. So really thrilled to have Lucas here. I guess you could tell us a bit more about yourself and what you guys do, what you do. So go ahead. Sure.
Well, thanks for having me, Scott.
Of course.
My name is Lucas Outumuro. I'm senior analyst here at IntoTheBlock. We're a crypto analytics platform. So we intend to cover every single data point for crypto assets. So of course, as Scott said, we're mainly focused on the on-chain side of things, which is blockchain data that's native to crypto assets. But we also cover other aspects such as derivatives, order books from exchanges, and social metrics. And one of the things that I've been working on a lot this year has been DeFi. So as many of you guys know, and Scott was saying, it's been one of the strongest forces for crypto in 2020, especially in the summer. And my research there has extended to our new analytics page. Essentially, we believe that DeFi is here to stay, and we think that there's a lot of opportunities there, both on the trading and like the user experience of it. And yeah, essentially, I wanted to cover with you guys some of the analytics that we have, and is it just hype, or is there actual value behind DeFi? I don't know, Scott, if you have something to say, or if I should just...
Yeah, just right before, we're going to let you share your screen in a second and go into it. It's such an interesting topic this year because it went so crazy for a while there, and you saw just all these projects like you'd never heard of, and a day later they're listed on Binance and they're being traded and they're rug pulling and they're going to zero. And I think that there's like a interesting differentiation. All these things were sort of thrown into one basket as DeFi, but it's not really the case, right? You can kind of break it down into other things. We've always had the Voyagers and the Celsius and the BlockFis where you can just go stake like a bank and get your interest, and that's DeFi, right? And then you can go all the way to the other side, CFI if you want to call it that, but right. And either way, it's a way to earn yield on cryptocurrency, which, but then you go all the way to like 1000% APR yield farming and flipping coins back and forth and food coins and all this stuff. So I think we saw a slight bubble pop on some of that, in my opinion. And now actually that's probably a healthy thing because, as you said, I think now we can see it sort of mature and move into the future. So I can let you definitely go into it as just sort of my hot take on what's happened in the last 6 or 7 months with it.
For sure. Yeah, I definitely agree in that it's definitely grown into that type of term that people just try to throw anything and classify themselves as DeFi to take advantage of the hype. But yeah, I'll dive into some of the main points and what can really be considered DeFi. Hopefully that helps clarify.
Awesome. And let me tell everyone who's listening as he does this that you can definitely feel free to ask questions, and I'll try to get to those because at the end of the day, I'm doing this so that anyone can sort of get a better understanding themselves. So if you have anything that you want to know, just ping us in the chat and feel free to engage. Go ahead.
Perfect. Yeah. So I wanted to show quickly IntoTheBlock first, in case you guys are not familiar. We're an analytics platform. And of course, I'll speak about most of our work in our DeFi Insights section. Before that, though, I'll clarify just so that everyone's on the same page. What exactly is DeFi? You may be wondering, and we classify DeFi as, of course, as you can imagine, open financial services that share three main characteristics. And those are that they're permissionless, in the sense that they're open for anyone to use them. Absolutely anyone with an internet connection can obtain financial services right now through DeFi protocols. They are trustless in the sense that they don't have a central third party, or at least they're in the process of decentralizing themselves, and don't have like intermediaries taking fees like in the traditional finance system. And finally, they're composable, which is something completely native to DeFi, and it's pretty cool. It's what some describe as money Legos, because essentially you can have one protocol or like a decentralized lending or exchange, use another protocol's product and interact with each other in ways that's not possible with current financial applications. And so, yeah, with that in line, at IntoTheBlock, we've built a set of analytics covering things like the market cap, of course, how they compare versus Ethereum. Since most of these are built on top of the Ethereum blockchain, it's pretty useful to compare how DeFi tokens are doing versus Ether. Of course, there's DeFi in other blockchains, and it's just getting started there. But to be honest, most of the used applications are in the Ethereum blockchain, at least at the moment.
Sure.
And there's, sorry, you want to say something, Scott?
No, I was just agreeing.
Oh, okay.
Just,
Yeah. I know there's people that support other blockchains, and I'm all for that. And probably in the future, there will be more applications in other blockchains. It's just the current state in 2020. And I wanted to dive into some of the hype. As Scott was mentioning, during the summer months, we saw a bit of a bubble, but it's since bounced back. This is from CoinGecko. They do consider some tokens that we particularly IntoTheBlock may not consider as DeFi, but this is for the top 100 DeFi tokens, right? And at the beginning of the year, they were really just like 10, 20 at most. So even though it seems like they've grown over 20x, well, nearly 20x, and some of them actually have appreciated that much, most DeFi tokens, and I brought here the DeFi perpetual futures from FTX, are still below their levels seen in late August, before September crash. I know, Scott, you're a fan of the technicals here. So we see a pretty big correction, and then it's bounced back since November, sort of forming a triangle, ascending triangle here. I'm not a big technical guy myself, but thought your audience
that's clear. Yeah.
might appreciate that. And so that's on the token side of things, but is there actual value behind it? Well, many of you may be familiar with this. It's probably one of the most popular metrics used to classify, to quantify DeFi's growth. It's total value locked. Just to clarify, in case you guys weren't really sure what it means, it's essentially the amount of liquidity supplied by users to use these protocols. So for instance, if you're using a lending protocol like Compound, this is the amount that you supply to this protocol to earn essentially returns on top of that. This capital then gets lent out to users who borrow on the other side of the equation and get financial services. So it's essentially the total amount trusted to DeFi protocols in terms of volume. And I wanted to speak about also, even though this is a great metric because it's a unifying metric across all DeFi protocols at the moment, it just shows one part of the picture. So it's just the supply side, right? So even though there's over 15.8 billion right now trusted in DeFi, up from 600 million, it could be, I'm not saying that's the case, but it could be the same person or group of people just providing more money to these protocols, right? So It's important to take into account other metrics on the demand side, which is something like what we show here at IntoTheBlock. So for lending, for instance, we show demand metrics like the total amount of loans outstanding, which is actually the amount of loans that are getting taken out, right? And there's also a lot of discussions about the numbers of users. The issue there is that you can't really quantify it because one person can have multiple addresses. So that's a complicated topic. But on the demand side, there's definitely a lot of metrics that you can see to get a full picture of DeFi.
Can I ask you a question really quick,
yeah,
Lucas? So yeah, there's so many metrics, right, to kind of quantify the success of DeFi. Obviously, you touched on the fact that market cap is very misleading because, you know, if there's 100 times as many coins, of course, the market cap is going to be much higher, and it doesn't really tell you much about the success of the leading projects. Is the amount locked in DeFi total, is that the best metric we have for the sort of health of the DeFi system? Or do we kind of need to dig into all of these and come up with a thesis as a result of it, because it's sort of nascent and new and there's no really way to necessarily say it's doing better, it's doing worse, it's down, it's up?
Yeah, it's a tough question, really. At IntoTheBlock, we don't like to use only one metric. We always encourage to use more. The really good thing about total value locked is that it's a unifying metric. As I said, it can be used to most DeFi services, regardless if they're lending, derivatives, DEXs, decentralized exchanges, or whatever. So it's really good because it can put all the DeFi protocols in the same page, at least the vast majority of them. But in reality, we suggest for each use case. So for instance, for lending, we built our own dashboard for metrics for lending, and also for DEXs, we have our own dashboard, and we're looking to launch more covering metrics specifically to these use cases. So that way you can get a fuller picture. Because for instance, one of the issues with lending, comparing TVL, total value locked for lending versus for DEXs, for instance, is that the lending protocols, since they lend out your money, so it's borrowed from a counterparty on the other side, it's not included in the total value locked itself. So for instance, you see here, Compound's total value locked is not pretty low, I should say, but it's lower than the actual amount of capital supplied. So if we have a known section in Compound. So a lot of people think it's just the capital supplied, but in lending protocols, total value locked discounts, just give me 1 second as it loads, you'll see the total value locked is really the difference between the total supply minus the amount borrowed for lending protocols, which is why it ends up showing Compound really as like the fourth highest in total value locked, but it really is the highest protocol with the most amount supplied, which I think most people don't really know.
Yes, you really need to dig into the data, or it's very misleading, because obviously it's not locked if it's being lent. It's been sent out. It's outgoing, but that's not a reflection of how successful they are. In fact, the more loans they have out, probably the more successful they are. And so the metric looks like they're not doing well because they're loaning it.
Exactly. That's a great way to put it, Scott. And yeah, that's why we encourage people to dig in. Because with DEXs, for instance, they don't lend out the capital. It's just sitting there. Well, not sitting there. It's participating on the automated market making process, right? That gives users also liquidity provider fees, but it's not lent out. So of course they're going to have higher total value locked if that demand side metric's not discounted. So that's why we think it's better to compare protocols within the same group, and why we compare, for instance, Uniswap versus SushiSwap. And we also provide to compare across protocols in like the all DeFi. But our intention and what we believe is that it's better to compare between the same group or use case, to say.
Right. So we have all these incredible metrics, right, to sort of show us the health of any individual platform or the health of it in general. I guess the real question then becomes, if I'm a trader or an investor, why do I care, and how do I use this information to actually make money and you know, for actionable for trading or investing in specific things?
Yeah, so it's definitely a point that most of us in crypto are interested in. I would like to think that we're at the point in crypto where there's fundamentals and there's starting to people to have like bigger VC funds investing in it, and they care of these metrics like demand side, like borrowing and things like that. So that's more for fundamental investing. And there's also metrics. For instance, what we did here with the DeFi versus Ethereum, I wanted to do it, and I think we will still edit it so such that it's more like this, where you compare DeFi's performance versus Ethereum, which is kind of like a DeFi dominance versus Ethereum. So that's more in line with the current trading that most people in crypto currently use, and more short term, of course. But the metrics that we supply at IntoTheBlock, it's mostly focused on the fundamentals, which in the long term should, in theory, lead to higher returns for investors if you spot one protocol that's growing a lot and bringing value back to its users.
And for those who have not participated in this or haven't traded it, what is the best way generally to gain exposure to these assets as you find the one that you want? Is it still, on the centralized exchanges? Do you just trade the ones that are available on the Binances of the world, or do you go out to the Wild West of Uniswap, or do you dive even deeper into some of these other, swapping, or do you end up as a yield farmer and you're going back and forth between all of these? How can people really participate?
Yeah, it definitely matters on your experience and just how deep you want to dive into it. So right now, centralized exchanges have caught up, at least for the blue chips, which are just the bigger DeFi tokens. These are available in Binance, Coinbase, most large exchanges. But I brought here our DEXs, decentralized exchanges tab, just because there's a lot more tokens trading in decentralized exchanges, because they can list permissionlessly without having to verify with the exchange. They can just launch immediately in decentralized exchanges. So they're going to be able to have access to the long tail of tokens right away. So if you're really deep into DeFi and are investigating, it's definitely better to use Uniswap and SushiSwap, at least for some tokens. Though keep in mind that there are slightly higher fees from trading in Uniswap and SushiSwap, especially if gas fees are high. I learned that.
Yeah, they were high again today.
Yeah.
There was that nice lull where it was back to being $1, $3, $4. Now all of a sudden it's $30 to speed it up. The first time I ever tried to do any sort of yield farming, I'm trying to remember it. I think it was based. Was it one of not Base protocol, but the old one?
Ample fourth, but decentralized.
Not the new Base protocol, and it was a $3,000 gas fee on a $10,000 transaction or something. And then I tried to send it back out. And by the time I had lost $2,000 doing nothing. It was really fun. I think that people will find it's not, you can have some pretty rough experiences still going through these platforms and trying to figure out what you're doing.
For sure. It's still very much in the early days. So even though it's taken off in 2020, costs like this, they still make it prohibitive for the average audience to be in DeFi and use DeFi protocols. So that's definitely one of the things with layer 2 adoption starting. That's one of the things that should help DeFi reach another level. Probably in 2021, there's already some layer 2 adoption. I don't know if you follow Synthetics, for instance.
Sure, of course.
They successfully use optimistic rollups on their sort of like a testnet. I don't know if that's the correct word, but you were able to stake through the testnet and the fees were negligible. They were 0.01, if anything. Really, you just sign and approve it and you obtain your staking rewards without any fees. So that in theory should lower the bar for anyone with whatever amount of capital to use DeFi and profit from it, which is something I'm looking forward to next year.
Yeah, it's really cool. I mean, it's still, to me, we're still far from your just average Joe being able to figure this out and sign on and do it. But what I want to ask you, and I think is the question that I get the most, is what does this all mean for Ethereum, right? I mean, as you said at the beginning, it's all, DeFi exists on a number of chains. There's reason for optimism and excitement about quite a bit, but, Ethereum is kind of the Xerox name brand of DeFi and everything else, So what does that mean for Ethereum price? We see these gas prices. We know that means people need to buy Ethereum to participate. You have to buy Ethereum if you want to be able to participate and use Uniswap, right? So shouldn't that inevitably mean number go up?
Yeah, so in short, we have definitely seen that in 2020, because of course to use DeFi protocols, you need Ether to pay for gas. And you can see right now, approximately 6% of the circulating supply of Ether is locked in DeFi protocols, around 4.6 billion. This is actually down from around, I believe, 9%. So since
Yeah.
ETH2 staking launched, we definitely saw a large amount move to staking. But in reality, if you think about when the fees are lowered in a way, there's less necessity to spend more ETH to use DeFi.
Right.
I know it sounds kind of counterintuitive, but if you lower the fees with layer 2, you don't need as much Ether to spend, right?
Right.
But what they're doing essentially for Ether to take to benefit more from this is EIP 1559, which benefits from transaction fees by the burning mechanism, which in theory should lower the supply of Ethereum as transaction volume increases. So if DeFi volume increases, even if it's on layer 2, it should in theory burn more supply of Ether and benefit Ethereum holders in the long term.
That makes perfect sense. We did have a couple questions here, and someone asked, "Is there a report on this that I could read?" And I know you sent me an awesome PDF already today, and you guys do this all the time. But where can people, where can somebody find that? Oh, there you go.
Yeah, it's a
He's
great question.
ready. He's ready.
So we have gone in depth into DeFi in 2020. So maybe I can share this in the YouTube channel where we speak on a very comprehensive level on DeFi. It's 20 pages, but it also has like 2 pages of ads, so it's slightly shorter. And people here can get a full in-depth analysis of the main use cases, the key metrics on DeFi growth, assessing risks, which is a part not that doesn't get enough conversations going. It's of course something to consider, the risks. I can also dive into that if you're interested. I won't give
Sure.
the whole overview, but I also dive into lending, decentralized exchanges, other DeFi sectors and protocols, and sort of the road ahead in 2021 and beyond for DeFi.
Yeah, that would be awesome. And when we're done, if you just remind me, I'll share it in the comments so that when people watch this back, in the descriptions, when people watch it back, they'll have access to that and they'll be able to view it. Because I think that that's a really good introduction and a solid place to start for all of this. And then obviously they can sign up and dig deeper into their tools.
Awesome.
Yeah,
Yeah, it's free. It's free. So I would
yeah, of
encourage
course.
anyone to give it a read.
I've had a few people ask me this, and I don't know anything about it. Do you have thoughts on the DeFi project Cover protocol?
Yeah, so Cover Protocol is an insurance protocol, right? Similar to Nexus Mutual, which was sort of like the first one to gain traction um, out of the insurance protocols. They provide insurance for things like yield farming. So, for instance, if they get hacked, you receive funds that you're essentially providing there to cover, as the name implies. So it's really good. It's a service that I imagine has potential to keep growing as DeFi grows, because people will seek to hedge their bets in case there's a hack, which of course is one of the biggest risks in DeFi. And one really cool thing that I've written about is that Cover has merged with Yearn. So I have an article on the Defiant speaking about this, how Yearn essentially took Cover, and you might have seen the merges became pretty big for Yearn. They also merged with SushiSwap, with Acropolis. There's like 5, I'm forgetting more. Cream, which is a lending protocol. And it's pretty cool how all of these services are merging with Yearn. So I know I took a segue from Cover to Yearn, but they're now part of. So if you go to Yearn Finance, for instance,
Sure.
you see Cover here, which is new. So they're integrating with the Yearn protocol, and you can obtain all this suite of products within Yearn. So I think that's pretty cool that those merged and they essentially share their community and resources to benefit towards like decentralized finance what they're calling the Amazon of DeFi.
Yeah, I think insurance is going to be a huge booming aspect of DeFi in the next year. I think that we're going to see those grow tremendously. What else do you see like as the future trends, coming out of 2020 and into 2021? What parts of DeFi do you think are going to really excel?
Yeah, so unfortunately at IntoTheBlock we haven't had the time to make a section for this yet, but for derivatives we're seeing tokens appreciate. So synthetics, there's SynLev, UMA. We've seen price action in those, but the usability and like the volume trading in those derivatives hasn't increased on par to derivatives on centralized exchanges. I think they have some like technical issues with providing leverage and doing so in a decentralized way. But if they're able to get those pieces together, I think just comparing traditional finance versus regular finance versus decentralized finance, sorry, in the traditional finance world, derivatives are much bigger, of course, than the stock market itself. So it would make sense for derivatives market to, in the DeFi world, to also go down the same route. We've seen in centralized exchanges in crypto, for instance, in Binance, DeFi derivatives trading volumes already surpassed spot trading volume.
Yeah, of course.
So I think that's one use case that hasn't evolved as much, even though they have really big communities, but they're still not getting that much traction in terms of volume. So that's one. Other than that, I still think in 2021 we're going to see more protocols work with each other, like the money Legos aspect of it. So that's going to be pretty interesting to see what use cases they come up with, and also how yield farming evolves. So of course in summer we saw people just ape into something, as they like to say, for thousands % of yield. That's not sustainable. So of course they have to give an incentive for people to hold those tokens. So it's going to be exciting to see what they come up with. One of the things that I personally think more protocols will do is give out sort of like proxy dividends via staking rewards. I know this may sound a little confusing for those not that deep down the DeFi rabbit hole, but essentially like what Yearn does, that they earn revenues and you stake your tokens and you earn part of those revenues for providing your liquidity to the protocol. And that's good if they implement into yield farming, because it creates incentives for the users to hold rather than just dump the yield farm tokens.
That makes sense. So we can't expect to get 10,000% APY in 2021.
Probably not. If you do see that, to those watching, be careful. There's a lot of people taking advantage of the hype. So of course, do your own research. I was going to generalize against food coins, but there seem that there's some legit ones now. So I won't.
Yeah. But yeah, so that touches on another topic. People, if we're going to go back to basics, people have heard the term rug pull probably like 1,000 times in the last few months. And even I know there was a pretty big one 2 days ago, I think, in the last couple of days. So what is the risk there with a rug pull? How does that happen to people, and how can you sort of avoid that?
So it's like a memetic term, right? So like there's no clear definition for what a rug pull is. But what I've seen with like the most infamous rug pull, which is probably the Sushi Swap rug pull, is just like they're not as decentralized as they claim to be. So for instance, in the Sushi Swap scenario, they still had ownership of the private keys, and they had access to the developer fund, which was going to be allegedly distributed to developers. But the creator, Chef Nomi, took out with the funds, and at the end they ended up returning them. But there's many other rug pulls where they haven't returned the funds. So it's definitely good to watch out for these. There's protocols that, as I said, are trying to take advantage of the hype and don't claim to be as decentralized as they are, and they may attempt to take your money that's deposited. So I would suggest that you guys check if the protocol is audited, so that there's no risks, or at least less risks. There still will be, of users' funds being withdrawn from the protocol, which is essentially what rug pull is.
Makes sense. Somebody asked thoughts on Elrond versus Zilliqa. I don't know if they were asking specifically in context of DeFi or to me, but do you have any thoughts on that? Just trying to get to the questions.
Yeah, so I have limited knowledge of Elrond. I know they've gotten a lot of hype with their token has been one of the best performing, and you earn really high APYs. I do not think, to my knowledge, that they provide a decentralized finance service. And Silica is a layer 1 blockchain, high throughput blockchain. They, on the specs, they appear to be really high performing, but for layer 1 blockchains or Ethereum killers, like Silica, it's all about like what's being built on top. So keep an eye out to see if there's exciting protocols that are actually being used in these blockchains.
Right. Somebody said, I say Uniswap's superior service and position continues to propel its growth to the point that the project's TVL grows 4x from here and easily surpasses 10 billion in 2021. Do you think that that's reasonable? Do you think that Uniswap will find a lot more competition, or do you think that they're sort of leading the charge?
I think they're definitely leading the charge. SushiSwap has been able to get away with increasing their liquidity mining rewards. Am I still sharing? Yeah, I'm still sharing my screen.
Yeah,
so that's good. So for instance, after the uni liquidity mining rewards ended, we see a lot of the liquidity and the TVL moved to SushiSwap, which has been increasing. And right now they're almost, well, like 300 million difference, but it was a much bigger difference before. Unfortunately, I can show it in the chart right now. But we see that the trading, even though the liquidity quickly shifted, so you can see in the top most liquid pools, the liquidity quickly shifted to SushiSwap. The trading, people are already more comfortable. They created those patterns of using Uniswap. So the most of the trading still in Uniswap, even though you see more liquid pairs. For instance, WBTC ETH is more liquid, has got more higher TVL, but it's still more traded in Uniswap. So I think they're definitely taking the lead. There's very good in-depth research from the guys at Paradigm, the VC, claiming that in the liquidity providers, they will be able, so of course there's the issue of impermanent loss. Through this concept called volatility harvesting, they should be able to provide liquidity and earn more than just holding these two independently, which essentially would cancel out impermanent loss, and people would earn more money by supplying liquidity than simply just holding. And we actually have, for those interested in impermanent loss, we have an indicator on that. So in short, I've rambled a bit, but if they are able to solve impermanent loss such that users always profit from providing liquidity, I think TVL can easily get to 10 billion and beyond, especially if we see more institutional adoption of DeFi.
Yeah, I guess that's the big question. And we see all this institutional adoption, obviously, of Bitcoin finally happening. Mm-hmm. So I think it's just going to be a trickle down. Obviously it'll Bitcoin first, then now they're already starting, Grayscale saying that they're here getting a lot more calls about Ethereum than they were about Bitcoin, and then probably assuming that the market remains, high, we'll probably see a trickle down. Could you talk about, I know everybody understands, obviously, that Ethereum is sort of the core of DeFi, but there are interesting things happening with Bitcoin and DeFi as well. Everybody's heard of wrapped Bitcoin, but they might not know what it is. Maybe you can talk about that a little bit, because I always get that question as well.
Correct. So I had just stopped sharing my screen, but
share again.
I'll share again. 1 second. Okay. So wrapped Bitcoin is a tokenized version of Bitcoin, and there's more. It's not just wrapped Bitcoin. There's RenBTC, there's TBTC, which is more trustless. It's more decentralized. And wrapped Bitcoin itself has been growing a lot. I'll show the market cap. And essentially what it is, it's users supply BTC to a contract or entity. In Wrap Bitcoin's case, it's BitGo. Just look at this chart. And essentially, by supplying liquidity to, Bitcoin to Wrap BTC, BitGo emits more WBTC pegged 1-to-1 to the price of Bitcoin. And we see here that its market cap, which is the total amount of Bitcoin supplied, has grown from 400 million or so to 2.6 billion. And most of it is in DeFi, as you can see here. So for this chart in IntoTheBlock, we aggregate Rent BTC, WBTC, and BTC++. But we've seen a slight decline in the amount of Bitcoin on Ethereum, actually. But the dollar amount has been increasing because the price of Bitcoin has been increasing, of course.
Right.
But yeah, it's definitely something that I have a good paper on, just a plug. It's called Why Bitcoin on Ethereum is Just Getting Started. And it's because it's the pristine collateral, essentially.
It's the best collateral there is.
Yeah, for sure. So even though Ethereum is the most credibly neutral within Ethereum, Bitcoin's the most liquid and what most institutions hold. So if you can earn yield on Bitcoin, so right now most Bitcoin's just sitting there idle. If you can earn yield on your Bitcoin upwards of 10% a year just by sitting and depositing in a contract, it's a no-brainer in my opinion.
Yeah.
So it's still risky in the early days of DeFi, but I can see it as DeFi grows, Bitcoin and Ethereum will definitely grow with it.
Right. I mean, we've seen, like, just to pivot from there, like the OCC has, this year obviously was huge news when they said that banks will be able to custody Bitcoin. Mm-hmm. We see Kraken becoming a bank. We see sort of all, BitGo, I believe, trying to become a bank. All these things, or Paxos, one of them. And at the end of the day, they're going to lend it, or they're going to lend money against it, right? If a bank is going to hold it as collateral, they're going to make a ton of money by lending against it. And Bitcoin really is the most, it's a deflationary asset, and it'll be held there. It's the best collateral ever. It's that your house is, not sitting in the bank. Your Bitcoin is. So
yeah, and you can earn off of it. And that kind of dives into CDeFi, or centralized DeFi.
Right.
As ironic as that can be. But I do see centralized exchanges like Kraken. I think Coinbase is already exploring it, having like a smart savings account where you can have stable coins or Bitcoin, and this is deposited on DeFi protocols and earning yields for you, and a win-win scenario, really.
Yeah, you can, like what I said right at the beginning, the Celsiuses and Voyagers and BlockFi's, you can already earn 5.5%, 6% on your Bitcoin, and 8.5% to 10%, depending on where you are on your stable coins. Imagine when a real bank gets a hold of it. They're not going to offer you those because banks like to steal your money. They could offer you that on your dollars right now if they wanted to. They just choose not to, right? So, but I think that is the future, is that it'll be a collateralized asset that you can earn yield on without, having to wrap it and throw it into these protocols to figure out how to make money on it.
For sure. And as you were saying, the yields are probably just going to be better in DeFi because they're not extractive. They don't take the fees. So as you can see here, I brought up the chart from lending protocol, lending and borrow rates. You can borrow, for instance, DAI for 6%, and you can earn interest on top of that so if we're using the same exchange on DYDX at 4%, and in USDT in some cases you can earn as much as 12%. And the reason why these are so high compared to traditional finance, where it's like 0.6% at most, and the reason why these are so high is because all of the borrow rates paid out here are distributed between the people supplying the liquidity, which is completely non-extractive process. If CDeFi does take off, it will likely take fees from this, lowering the yields, but of course being like a custodian for users and making it easier to use.
Yeah, that makes total sense. I know we have to wrap up here in kind of the next 5 minutes, unfortunately. So we do have like one or two more questions here. They're probably worth getting to.
Definitely.
Someone asked how much fees one pays to wrap BTC.
I haven't done it myself, really.
Neither.
It's probably just easier. You buy a WBTC on Uniswap, or I believe even Binance has WBTC right now. So I would suggest that. But I know large entities like Three Arrows Capital and Alameda do mint WBTC constantly. I would be surprised if the fees are significant. I don't think so.
Someone asked, what is the response to the DeFi token audit scam problem?
DeFi token audit scam problem.
I'm not even aware of the audit scam problem. I thought the audits were what was preventing the scams.
In theory, I guess people can still take advantage of it.
Fake audit.
I don't know.
Yeah, of course.
I don't know any particular. I don't know if this person's referring to just one scam in particular, or if it's a recurring thing. And in my opinion, from my knowledge, I should say, most auditors are not scammers.
Yeah, of course.
The ones that we've talked with and IntoTheBlock, of course, they have their reputation on the line. But we do see some projects that get audited and still get hacked because sometimes they can't cover every piece of potential hacks and exploits. But I don't know. I guess auditors will get smarter and more. There's definitely a lot of demand for auditors that I know. So their prices have been increasing. So that should drive more quality of auditing down the line.
Right. I mean, auditing would be a weird place to scam because you'd get away with it basically once.
Yeah.
It's like that your credibility is dependent on the quality of your audits if you ever want to get business. And someone asked, talking about the Wrapped, what do you think about Wrapped tokens and every DeFi creating their own bridges? Is this sustainable long term, or do you think there'll be one clear winner?
So I think for Wrapped tokens, we'll see more blockchains, more protocols do them. Well, they don't do them themselves, but there's people that do it for them. I think there's now like PLTC from P Network for Litecoin. And there's more that will come up inevitably. I think if DeFi continues being mostly within the Ethereum blockchain, I think there's going to be protocols that have to migrate with their own wrapped token in Ethereum to be able to benefit from DeFi. I believe even one of the Ethereum killers, Hedera Hashgraph, is launching their own wrapped token, which is interesting.
Ethereum killers. Is there really going to be an Ethereum killer, do you think?
Oh, that's a hard question. I think the community and the advantage that Ethereum has in that
so
sense,
far ahead. Yeah.
So far ahead. So even though there's some that are showing potential and more projects being built on top of them, like Cosmos and Solana, I think Ethereum has definitely the lead, and it's up to them not to drop the ball.
Yeah, not to drop the ball. And then also, I mean, beyond just Ethereum's place in DeFi, like I said, we're seeing steps towards institutional adoption and interest in Ethereum, even if it wasn't used like sort of as like this, the little cousin of Bitcoin as a store of value or something that they'd be interested in. We hear Grayscale's buying more than Ethereum than it's being mined and is saying that, I said, they're getting more calls about Ethereum than Bitcoin. So yeah.
CME options for Ethereum coming next year. So I think they're not going to go to Solana all of a sudden. They're probably going to go to Ethereum, which is the second most comfortable.
This first mover advantage, I think, is huge for them. So yeah, we have to wrap up in a couple of minutes. Could you tell everybody where they can follow you? There is a link to IntoTheBlock. I will add Lucas's Twitter to the description as well. And then we can also, if you send me the link to the report, I can add that there. And then if there's any other questions, Lucas can jump into the comments, I think, and probably respond to them. But awesome. We are going to sign off. So where can everybody follow you? Just tell them.
Yeah, I'm available in Twitter. Starting to tweet more, even though it wasn't my nature. But yeah, I'm getting a hold of it. So you can follow me in Twitter. IntoTheBlock, of course. I would encourage you guys to sign up for a free trial. I'll post the report in the comments. I'll also stick around. I know you got to leave, Scott. I'll stick around for a couple of minutes if there's more questions. Thanks for everyone for tuning in. And thank you, Scott, for having me here. Pleasure.
And thank you, everyone. And I know we're coming into the holidays, so everybody have a great holiday. And stay warm down there in frigid Miami, buddy. I know it's hard. Thank you, guys.
Well, thanks, everyone. Talk soon, Scott.
Yes.
Happy holidays.
You too. Awesome, man. I'm sorry I had to run like that.